Well, for more on the macroeconomic picture and the impact on investors here at home, we're joined now, of course, by Sebastian Evans, as we flagged just before the break, fund manager at Naos Asset Management, and of course our guest host today, Greg Canavan from Sound Money, Sound Investments, will be sticking around. So all in all, I guess, Sebastian, equity markets taking a pretty big tumble following the announcement of the US Fed's Operation Twist. Do you think this is a sign that investors were expecting too much from the Fed?
I think, personally, I think you've seen a lot of hedge funds, especially, and a lot of investors being rather short going into the announcement. I think you saw some squaring off of that yesterday. We're just of the view it really confirms what everyone would have expected, which is that overall that it is still quite bearish out there, and the Fed really don't have many strings to pull. So I think overall it was quite negative, but I think the market maybe was a little bit surprised going into that.
Greg, do you think that markets really were expecting QE3? I mean, there was a lot of talk about it, and it seemed pretty out there if something like that did eventuate. But they were sort of holding on to minor hopes, I think, weren't they?
Yeah, look, I think they were probably a little bit disappointed that there wasn't more, even though I really don't understand why, because the Fed, I think, has created a lot of the issues that we're now dealing with. I mean, low interest rates have been low for many, many years, and they're exacerbating the situation, not making it better. But there's always a tendency for the market, and especially the very speculative end of the market, to want more Fed-created dollars to flow through the system, and for a short-term speculative play to run off the back of that. So I think, yes, there was disappointment, probably some disappointment there wasn't some mention about the issues in Europe and what the Fed can potentially do to mitigate the fallout. I mean, there's an impending Greek default coming up probably in the next couple of weeks, if not months. So I think just that the uncertainty that's raised, that they've done only what they announced and there was nothing additional to come through, has probably spooked the market a bit.
Yeah, and I mean, everyone's focusing on those disappointing equity market reactions. On the upside, though, we're seeing Australian bonds rally on the back of Operation Twist. So a bit of a positive in some regards, Sebastian.
In some regards, yes, but I suppose when you really look at the equity markets, it's really a confidence game, and I think the fact is between Europe and now in the States, especially now, there's just very little confidence within, politics and governments alike, and I think you will see, as mentioned before, Greek will default. I think that's only a matter of time, and I think it's really a way, we really need to focus on how the Europeans can focus on moving forward, and right now there seems like there's very little plan to do that, and they still seem to be sticking with the same game plan, which the equity markets have continually told us by moving downwards, that there's no longevity in this plan.
So do you think that the Troika will come to the saving grace, at least for the next set of repayments that are due?
Oh yes, they may, and they may not, but I think the underlying problem is really not, that doesn't fix the underlying problem. I think at the end of the day, Greece needs to default. They need to look at ways to cut the debt. They need to recapitalise, and the banks need to take a haircut. I think otherwise the underlying problem is really not going to be addressed.
Greg, do you think that it's worrying at all that the Fed basically, it appears, has yet again, I suppose, given into market pressure for some sort of stimulus package or stimulus of some sort, given that the latest Operation Twist really won't do much to impact the underlying problem, which is its economy?
Exactly. Look, the underlying problem and what needs to be addressed is debt restructuring, and that counts for Europe as well as the US. The best thing the Fed could do, even though it would be damaging in the short term, is start to normalise interest rates. We need to encourage saving in the world. We've got way too much debt accumulation, and encourage more debt accumulation is just going to send us deeper in the hole. And I think the markets are finally starting to wake up to that and finally starting to realise it. The issue is the politicians and the authorities do not want to put more pressure on the markets and do not want to send them lower. They've only got one game plan, and that's to create more debt, and it's not going to help.
Sebastian, your view on that one? Is it a bit worrying that they're again, I suppose, faltering and putting in stimulus measures that aren't really going to impact the economy that much?
Well, I just think in Europe alone, I agree on the debt side, there is obviously too much debt, but I think with austerity plans and whatnot, I think you really need to be on two sides, and I think we're on the view there's a side that you need to grow your way out of it and to an extent inflate your way out of it, but I think the Europeans going ahead, cutting back as much as they can, especially with Greeks. I mean, the Greek underlying problem is that no one seems to pay taxes, no one wants to pay taxes, and no one really wants to work to a certain amount of years, and I think that is the underlying problem. So I think if you've got a huge amount of debt and at the same time you're trying to cut back as much as you can and there will be no growth, I mean, I just don't see how that fixes the underlying problem of paying down your debt. It would take, tens of years.
Sebastian, what about the shift in the Fed's tone in relation to the outlook for the US economy, now quoting significant downside risk?
I suppose that hasn't, it's not awfully surprising the way the equity markets have moved over the last month or two, and it really hasn't surprised us. But as you tend to see, I think when something announces, there's a level of investors, so it tends to work its way down right through to the retail side, retail investor base. There are underlying issues with the US economy, and I think the real issue that was mentioned before is how do they get out of this, and I think there is no short-term fix, as there was mentioned before. And especially now in regards to government and the two sides bickering over what to do and what not to do, I think that just creates even more uncertainty on how to move forward.
Greg, how likely do you think this issue in the US is to filter through to the Chinese economy, hence impacting our growth here at home?
Well, I think China's probably got its issues all by itself. I mean, after we had the credit crisis in 2008, China went on a massive stimulus program and effectively created their own credit bubble, and they've got a housing boom. That, in addition to trying to peg their yuan to the US dollar, as the US dollar has done easier and easier monetary policy, has created inflation and many issues in the Chinese economy. So I think irrespective of what's happening in the US, that China has some major policy issues to confront in the next 6 to 12 months, purely because they have an inflation problem, they've got a property bubble, and they're trying to manage that. But as we've seen, history shows that credit bubbles don't end well, and I think that's China's issue.
Yeah, we saw, obviously, Sebastian, the IMF cut its forecast for both global and Australian growth just yesterday. Do you feel the revised estimates are justified?
Oh, most definitely. When you look at the amount of uncertainty moving forward, you tend to revise down, you probably tend to continue to revise down for a number of times, and I think once again, with the amount of uncertainty moving forward, and there's been no respite in the amount of uncertainty and the lack of planning moving forward, you can't see that number either continuing to stay where it is or being any further revisions on the downward side.
We also saw, obviously, before we got into this, Assistant Governor, RBA Governor Philip Lowe coming out saying that the country's retailer should prepare for this ongoing weakness. He did highlight shifting patterns in consumer spending. This, though, actually lending a bit of support or benefiting the services sector somewhat.
Yeah, look, I think that the issue with when RBA governors speak is they're not actually telling the market anything the market doesn't already know. This information has been out in share prices. I mean, retailers' share prices have fallen heavily over the past 6 months. They've actually outperformed the market in the past few weeks as the market's fallen. They've already had their falls and they've gone through their tough times. The industry's starting to restructure. I think what he's trying to point out is that people aren't spending on discretionary material items, they're spending on experiences, and that's where services are benefiting. So from that perspective, that part of the economy is doing quite well. It's just obviously bigger pockets of the economy are really struggling as well.
Yeah, and Sebastian, RBA Deputy Governor Rick Battolino also speaking on the Australian economy overnight. What did you make of his comments in terms of monetary policy moving forward?
Well, it's interesting because you've seen a lot of the retail stocks, as was mentioned previously, that they have started to bottom out. And I think a lot of it, just from the investment community side, is a lot of people seem to be expecting rate cuts moving forward going into the end of the year, or October, November. But according to Rick Battolino, he's tended the other view that inflation will force the RBA's hand to either leave rates or increase rates eventually. So if that's the case, I think you might see retail stocks continue to slide eventually.
Yeah, this is an interesting one because obviously today we had the Westpac ACCI Industry Trend Survey which showed a further weakening in business conditions. It's, I suppose, prompting calls certainly from Westpac that the RBA needs to cut rates again. But Greg, given I suppose the RBA's comments in terms of market pricing of rate cuts, that they're quite askew, do you think that we'll see this?
I think we'll see a rate cut before we see a rate rise. I think the issues that Australian economy faces is our rates are strong because of what's happening in China at the moment. It's pushing up our terms of trade. It's pushing up our nominal income to quite high levels, and that's flowing through. That's the inflation that's flowing through into the Australian economy. And I think the RBA is doing a very good job at jawboning the economy and saying, look, rates are staying where they are. They will probably rise, but I think it's very finely balanced at the moment. And I think as the data plays out over the next sort of 3 to 4 months, the RBA will probably move more to the easing side.
Yeah, Sebastian Evans, your take on that?
Yeah, no, look, I tend to agree. I think you've seen a lot of the commodity prices and even the commodity companies within Australia, their prices have run well ahead of that. If you take any correlation to those prices, you'd expect the Chinese economy obviously to falter to an extent as well. And if that was the case, as we saw 2 to 3 years ago, interest rates can come off quite substantially. So I think there's definitely room for a rate move to the downside, even 1 or even 2.
All right, Sebastian Evans, Fund Manager at NAOS Asset Management. Thanks so much for joining us. Appreciate your time.
My pleasure.
Time for a short break. After that, though, we'll talk currencies and commodities and the Aussie dollar, of course, dipping below parity with the greenback today. Stay with us.